Investors piling back into tech stocks today, coming on the heels of yesterday's move to the downside. While our next guest is warning not to be fooled by some of these recent moves. They certainly have been the outperformers so far this year. He's actually pointing to some other areas to focus on for future investments. Joining us now, we want to bring in David Wagner, portfolio manager at Aptus Capital Advisors. David, it's great to see you here. So you're coming with some picks that you see an opportunity with for the second half of the year. When it comes to some of the moves that we've seen in tech, you actually like two names outside of tech. Let's start with Visa, your first pick. Why do you like it? Why are they positioned well?
Yeah, I definitely think it's time more for the average stock to succeed and more some of what they're calling the Magnificent Seven, maybe just to take a little bit of break. But simply put, Seana, I believe that the combination of double-digit revenue growth with mid-teen EPS growth and the stock trading at a historical discount on its multiple, well, that's going to check a lot of boxes for me here in this market. Though I do think that investors have been a little bit confused around Visa's recent stock performance. I think that really stems from the expectations that volumes are going to decline into the future. I mean, if you look at the Bank of America data coming out in May and April, it did point to some weakness on consumer spending, well, at least decelerated right now. So yeah, dollar volumes are definitely making people think that, Visa may not be a really exciting place to be right now. I mean, yes, it's already an overcrowded name, but I think that a lot of these problems are definitely getting discounted in the valuation right now. The stock trades at only a 30% premium to the S&P 500 when it tends to trade at a 50% premium right now. So, all told, I do think that the company's ability to protect on the bottom line in a variety of macro scenarios alongside a reasonable valuation is definitely a reason to remain invested in this name or add to a position.
Let's talk about the names you're trying to avoid, because there's a lot to parse through. These have been real favorites here, at least in the first half of the year. Two stocks you say you want to avoid are big tech. Google, let's start with that one because they've recently received two downgrades, the latest one coming from Bernstein. It's interesting to see these notes coming out talking about the concerns about AI on their search ad business, not necessarily their ability to compete on the technology of AI. How do you view that?
Yeah, Akiko, it's probably more of a tepid take here for me because I'm probably going to sound a little bullish on Google here right now because it's a wonderful stock to really own for the long term. If I had some type of portfolio where it was more of a set it and forget it, over the next 3 to 5 years, I would happily own Google in it. But I do think in the near term that there's going to be some short-term headwinds here, especially after the recent price movement. I mean, most of all, I do think the stock looks fairly valued as the narrative here has definitely caught up with the fundamentals. But yeah, that's definitely has allowed this company to, be up 40% since its market bottom back in November. But it does appear, as you just mentioned there, that, Google search market position is definitely under increasing threat from Microsoft. And then you have a potential, for some type of financial problems from integrating Baird into Google search. Basically, the company's risking creating some near-term air pockets on the revenue side by cannibalizing some, prime real estate for their generative AI results, which is definitely going to take away ad space from its buyers. But, I think it's kind of probably dangerous. There is some danger, I guess, it's probably the better way of saying it, moving to the sidelines on a name like Google because it screens really well. I mean, the company has a ton of cash. It's trading, like 20 times forward expectations. And the company still could see definitely a pathway to a 12% revenue growth CAGR actually over the next few years. But really from my seat, I think that the risk associated with this competition in search and then some potential margin misses definitely outweighs the potential upside actually from just some top line beats here.
David, another name that you're saying to avoid, Nvidia, that's like up 185% since the start of the year. Why is this as good as it gets, at least for now?
Yeah, I probably trimmed this a little too early, but I actually still am this name. I love the name, long term, but I'm probably going to continue to collect some gains here. And I'm going to mention it's not solely because of that massive move you just mentioned there, Seana, but really more it's just the injection in a portfolio from a price volatility standpoint, given that the stock is probably very highly valued in the eyes of many people. I mean, we all know that this is really just more of a narrative type of stock right now. And in the AI space, there's going to be winners and there's going to be losers because, it's a potentially very, very large market. So we know that there's probably going to be wild prices and valuations, some wild pricing just at the individual stock level. And that's probably what you're going to get here in Nvidia, especially as I mentioned with its valuation. But I think it's also important for investors really to understand the bull case here. And that's definitely around Hopper, because I do think that GPU will continue to drive positive earnings revisions into the future. Because what we've learned from past cycles is that data center cycles, they don't just last 1 year. So that last earnings report on their Q2 guidance probably isn't one time in nature. But the biggest reason, as I mentioned before there, Seana, that I'm on the sidelines is that there's probably going to be some air pockets in this price, because that's a risk of buying a name at this valuation of what they're trading at right now. If there is an air pocket on some type of earnings guidance, which is probably inevitable at some type of point, you could see the stock pulling back 20%. But like I mentioned before, I own the name, I've trimmed the name, but that's really because I don't want to subject a lot of my investors to all that price volatility within a portfolio.
David, is that something that's specific to Nvidia, though? Because we've seen a lot of choppiness in Nvidia's competitors as well, especially given the enthusiasm around AI. Is it specifically the concern around these air pockets that you talked about with Nvidia, or can you sort of put that thesis to some other names like an AMD and other chip makers?
Yeah, I think that's a blanket comment that can be tossed across a multitude of names. Look at Marvel, look at AMD, look at Avgo. If I were to play one there, Akiko, I probably would be playing more Broadcom right now, which I do own, more so because of the valuation. It's trading closer to 17, 18 times, while Nvidia is trading actually at a lower than historical multiple at 46 times. It's still below like an AMD and a Marvel. So I believe that, people here over the last 10 years have believed that price presages price movements, when in fact, over longer periods of time, price doesn't always presage price movements. Its valuation is one of the best drivers to presage future outperformance.
All right, David, before we let you go, let's get to your last pick that you actually like right now. You think it's positioned well in the insurance family, Progressive. What is the edge that you see in Progressive against some of its competitors?
Yeah, Seana, I really, really like Progressive right now. Probably a little too much, to be quite honest. But I believe that their positioning and profitability of Progressive really makes it a category killer. I mean, the company benefits from size. It benefits from scale. I mean, just look at the long-standing track record of its superior underwriting prowess. And then you also have a company that's experienced its fastest growth in about 21 years, which is aided by its dominant brand name and its multiple distribution channels. I think that the misunderstood part here, why it's only trading at 17 times, is that auto insurers pricing works on a 2-year lag. Go back 2-3 years. You had a substantial increase in used car pricings since COVID, but you had these higher loss ratios because these companies weren't compensated from an increase of premiums just yet because they had that 2-year lag. But now we're starting to see actually the exact opposite. You're starting to see used car pricing come down in a period where actually auto insurers are getting some type of tailwinds from rate increases. So just look what's going on in California in that case. But, that's really increasing the revenue, and that's increasing profitability with a healthier combined ratio. I think the knock on PGR is probably the exact knock you're going to give on Nvidia. It's going to be valuation. But I think here in this case, investors are miscategorizing the name because, yes, it's an insurer, it's a financial, but I don't see it as a financial at all. I actually see it as more of a consumer staple, in my opinion. And if you look at it versus consumer staple peers, whether you're going to throw out a Colgate, a P&G, a Pepsi, it actually trades closer to the lower end of its range, of its 2-year range, actually, by 2 standard deviations. So I would actually say this is more of a relative value here, especially if you're looking to become more defensive in your portfolio positioning without giving up some type of earnings power.
Yeah, certainly hasn't seen much move since the start of the year, up just over 1%. We'll see if the second half is better than the first. All right, David Wagner, portfolio manager at Aptus Capital Advisors. Thanks so much.